Has the market had you stressing out a little lately? Set it and forget it investing might be more your style. It's a strategy many investors have relied on for years. Our MarketBeat analysts, Chris Markoch and Thomas Hughes, join us today to kind of talk about this great strategy and also walk us through some of the top ETFs out there. We're going to get to those picks in just a minute. But first, guys, let's talk about set it and forget it. What exactly is the strategy?
Well, it's a basic strategy. It aims to reduce risk with due diligence, and it works. And it's really been around a lot longer than ETFs. It's the most basic strategy. In today's time, it was made famous by Warren Buffett. He's well known to take large stakes in companies and then let them run. He focuses on operational quality, the cost of cash flow, margins, and shareholder value. Dividends and share repurchases certainly aid the stock price movements and his choices over time. He's been so successful in his strategy, using this strategy, he earned the nickname the Oracle of Omaha, which basically means when he speaks, everybody should listen and go buy what he's buying.
We talk a lot about trades of the day and things that are happening, but there are a lot of people who follow this ETF Warren Buffett strategy. Chris, talk a little bit about what ETFs are in general for those who might not know.
ETF, it's an acronym. It stands for Exchange Traded Fund. An ETF trades a group of securities. You'll usually hear the word basket. So a basket of securities on an exchange, and it trades like a stock. It offers diversification in line with the index that it's following. That diversity makes it feel very much like a mutual fund. But it's different from a mutual fund in that the trades that investors make are execute during the day, like as they do them, just like stocks would. Whereas with a mutual fund, the trades you might make, even if you make it right at the market open, won't be settling until after the market closes that night. For many investors, it feels like the best of both worlds. They get the diversification that you'd get from a mutual fund, but you get liquidity and trading activity that acts more like a stock.
Well, we're going to go through some of the top ETFs out there, the most popular ones for sure. But
Sure.
first, here's some information on a tool that can help you track all of the ETFs out there.
Want to keep your finger on the pulse of the market? Text the word YouTube to 68285. That's 68285 and get free breaking news alerts from MarketBeat for the stocks that matter most to you. Don't miss out on crucial updates. Stay informed and stay ahead.
All right, guys, let's go through some of the top ETFs out there. Thomas, what's one of the biggest ETFs?
Well, the number one ETF on the market, and I could be wrong, but I think it was the first one or one of the very first ones. It's the S&P 500 index tracking stock, also known as the SPY or the SPY. Now, one thing that Chris didn't mention a minute ago talking about ETFs is that ETFs are passively managed. Mutual funds are actively managed. The manager can buy and sell stocks whenever he wants to and change the portfolio makeup. With an ETF, it's an exchange traded index tracking stock. And so usually what it does is it tracks an index. The S&P 500 is only changed once a quarter. And so this ETF only changes its composition once a quarter, which is part of why it's tradable and part of why it's got better cost ratios than mutual funds. But the reason why I like the SPY is because it's the largest index. It's the largest of the largest, most successful companies. It has the most ownership. Its volatility equals the broad market, so you're not going to have to worry about beta. And then it's got dividend and dividend growth.
If you're just starting out on this set it and forget it investing, Chris, is SPY a good place to start?
Yeah, it really is. I mean, when you look at ETFs, when you think about ETFs, what you want it to do for your portfolio, it doesn't get much more set it and forget it than the SPY. You get exposure to best in class stocks over a broad range of sectors. So you're getting that diversification. It's a great choice.
Now, Chris, if you want to go on to something other than the
Sure.
SPY, what's another really big ETF out there?
Well, so earlier I was talking about, I said there's like 2,000 ETFs. And one of the reasons why is because different investment brokers have their own version of the SPY. So one name you might look at, it's one of the more popular ETFs, is the Vanguard VOO. And it's Vanguard's version of the SPY, for lack of a better phrase. It covers almost all of the companies that are in the SPY. It has probably very similar weighting to the SPY. The difference here is that you're getting a slightly lower dividend yield in the VOO, but you're also getting a really low expense ratio at about 0.03%. And that's attractive for a lot of investors who are concerned about what fees might do for their overall gains over time. So that's something that Vanguard has that they can track. Some traders believe that there's a little bit less liquidity in the VOO, which is probably true because there's not as much volume with it. But if you're a long-term buy and hold investor, it's a solid choice.
Thomas, what are your thoughts on the Vanguard?
I mean, I love the S&P 500. It's what I follow mostly in all of my day-to-day market watching and writing and investing research. But if you're going to go with an S&P 500 ETF index tracking stock, I would go for the SPY. The reasons that Chris has pointed out, lower liquidity and lower dividend yield are part of that reason. If you want to trade the S&P 500, go for the best one with the most liquidity and the best dividend.
All right, so Thomas is not a fan of the Vanguard. Chris, what's another really big ETF out there?
Well, so if you're looking for something that's more sector focused, right now you couldn't do a lot better than going with the Invesco QQQ. Investors hear about this a lot. Even if you're not really heavily into the stock market, you've probably seen commercials advertised for the Invesco QQQ. It's a very technology focused ETF. I would kind of call it the technology stock version of the SPY because that's the only holdings in the fund are going to be the technology stocks. So you're going to see all of the Mag 7 in there. You're going to see big names. These aren't going to be heavy dividend stocks. They might be some stocks that happen to pay a dividend, but that's not why you're in the stock. It's for growth-oriented investors who are looking to benefit from technology stocks without trying to pick individual names.
Yeah, we talk a lot about those individual AI and tech stocks out there. Thomas, do you see a benefit in going with the ETF and instead of trying to pick just one popular AI stock out there?
Well, stock picking is incredibly difficult. I think statistics show that stock pickers tend to not really do better than the broad market. Individual investors can beat the broad market, but stock picking in general is not a great strategy. I think that investing in the Qs is a great way to get exposure to the tech sector and also to a broader range of stocks than what you're going to find in the S&P 500.
Is there more risk involved, Thomas?
It is a riskier ETF. It's got a higher beta. And with that tech factor, there is certainly opportunities for some stock price implosions. Volatility will certainly be the biggest difference.
With 2,000 or more ETFs out there, there's a lot to choose from. We went through some of the biggest ones out there. Thomas, what are some other ETFs that you're watching?
Well, one of the ETFs that I really like, especially from the buy and hold perspective, is the Noble, NOBL, the Dividend Aristocrat tracking stock. Now, the Dividend Aristocrats are a member group of the S&P 500, but these are the stocks that have increased their dividend for at least 25 years. Now, among the differences between the Noble and the SPY is that you're going to get a higher yield. You're going to get more aggressive dividend growth, enough to offset inflation. You're going to get reduced volatility. I think it trades with a 0.65 beta compared to the S&P 500, which is going to protect you on the downswings and set you up for bigger total returns over time. Over time, the ETF itself tends to match the S&P 500, but the total returns are much bigger because of the yield and reinvestment and the distribution growth.
Chris, how about you? What's another ETF that you follow?
Well, one that I've been following for a little while now is it's called the Global X U.S. Infrastructure Development ETF, and that's a mouthful. And the stock ticker is actually PAVE, P-A-V-E, which makes a lot of sense because this is dealing with infrastructure stocks. We're talking about the companies that do the things that help us with the roads and the bridges and all of the infrastructure that the United States needs to build. This has been taken off since 2020, got even further lift from the Infrastructure Act that passed in Congress in 2021. It's only been actively trading for about 7 years, but the chart just looks phenomenal since 2020. Now, some people would say that all of the growth in this ETF is priced in because the infrastructure spending has already kind of made its way into the economy and that this stock may be starting to stumble a little bit. However, I think with the likelihood that the Fed's going to cut interest rates coming in September, I think that could act as a catalyst for this ETF. And because the companies that are in this ETF are going to be the companies that are going to benefit a lot from rate cuts.
Thomas, any thoughts on Global X?
I think Global X is a great choice for a buy and hold portfolio. As far as ETF goes, it will add great amounts of diversification
Yep.
because infrastructure is what's known as a real asset. Real
Yeah.
assets are things like roads and bridges and dams and seaports, things that you can get a hold of. A lot of those businesses and operations and the building projects are protected by government contracts. Their payments are tied to inflation. So it's a great way to reduce risk, offset inflation, and get portfolio diversification away from just straight stock equities.
I'm surprised, Thomas, I haven't heard you talk about the Russell yet. I know we've talked about it before.
Right.
Tell us a little bit about that ETF.
Right. So right now, I think the Russell 2K, the IWM is a great choice. It's experiencing volatility along with the broad market. We're into some risk off atmosphere, a little bit of sector rotation, just some fear because of FOMC and the outlook for interest rates. But the FOMC is expected to cut interest rates. Lower rates are known to be good for smaller cap stocks. The Russell 2K should outperform the broad market over the next few years. And within that small cap arena, there is a much larger opportunity for growth. Now, the Russell 2K is not going to produce quadruple digit growth, but many of the stocks within it will. And that'll result in high double digit to triple digit growth for the Russell.
Well, there certainly are a lot of options for ETFs out there. My question is, how many should you be getting into? Do you just pick one and set it and forget it? Or should you be getting into multiple? Chris, what do you think investors should be doing?
Well, I think you have to remember that most investors don't want to, or they don't have the time to research different stocks or different ETFs. And I think one is just fine for most people, especially if it's an ETF like the SPY, which it's going to get you diversity not only in the tech sector, but in the energy sector. Again, you're buying best in class stocks, different sectors. It's going to be a positive return there. The one exception I would make is if you were going to look at different ETFs, there are so many sector specific ETFs. So if you wanted to do, for example, Thomas was just talking about the Russell 2000. If you wanted to have a little bit of exposure to the Russell 2000, that's great because you're getting exposed to some stocks that you might not get in the SPY.
Yeah, Thomas, what are your thoughts on how many ETFs investors should be looking into?
I think Chris is on the right track. You really don't want to have too many because there is a real hidden danger in over diversifying with ETFs. For an example, if you buy the SPY, the QQQ, and the diamonds, you're going to get a triple shot of Microsoft, Amazon, Google, Nvidia, all of the biggest, most market moving names. And so you're going to think that you're diversified, but you're really not going to be. This is part of why I liked the Chris's choice of PAVE so much, because that's going to be an ETF that will not have most of the same names as are in the S&P 500 or the QQQ. So when you're looking to buy more than one ETF, you really do need to be careful about that. As Chris was mentioning, there's lots of good subsector ETFs. The S&P 500 has 11 subsectors, and there's an ETF for each one of them. So if you think energy is better than utilities, you cannot buy the S&P 500 and just buy the energy sector, and which is a good move for traders.
Well, you've certainly given investors a lot to think about today. If you do want to just set it and forget it, these are some great options. But if you want to keep track of anything happening in your portfolio, make sure to check in with MarketBeat. Happy investing.